Okay, so today we'll look at two topics. As we move on, I'll be bringing in standards so that we don't start panicking when we remain with about a week or two before the exams. So today we'll look at IAS statistics on impairments. It's not a very long topic though. Then we're going to start, then we'll actually go to complex groups on group accounting. That is what we'll do today. Last time, I think we looked at, I did actually mention on IAS 36 on impairments that I think when we're actually looking at we were even looking at the impairments where we're looking at the carrying value and the recoverable amount. And we did say that on the recoverable amount, you pick the one that is higher between the fair value or the cost less of sale and which other one? There were two. Which other one? And the value in use.
Value in use.
Yes. So any of the two that gives you the highest number, that is what you're going to use in trying to test the impairment, whether there was actually an impairment or not. So when you look at these intangibles, let me just start from here. So we look at impairments on IAS 36. What we do first, we identify possible impairments. One on external, if there are any externals, influences that would actually cause the assets to be impaired, or if it's internal, we also look at those internal influences. Then after we identify those possible impairments, the second stage is to perform impairment review. If identified possible impairments, then will have to be done. Thirdly, we'll have to then now record the impairments. Like I did mention that if a company has subsidiaries, those subsidiaries or any other business that this company has, those businesses or subsidiaries, they'll be considered as the CGUs. So with these CGUs, the cash generating units, they will need at least every year to actually test or to perform an impairment review. So what are the indicators of impairment? Let's first look at the external sources. A significant decline in the assets market value, maybe more than expected by normal use or passage of time. I'll give this example. I remember then when Zim, it was going under. I was a bit young then. I think the decline started around 96, 97. I don't know, Victor, but somewhere there, I still remember I was still in Livingstone. I was staying at Vic Falls.
I think it's around the 94,
yes. Yeah. Around 94, yeah. So by then, before the decline of the Zimbabwean economy, every month and like this time around, our parents would actually take us to Vic Falls on Zimbabwean side. This is where we used to buy bread. We used to buy margarine. Those who used to drink, they would even buy what they used to call scud missiles. These scud missiles would actually flood the Vic Falls compounds there, and they started reselling. Do you remember the scud missiles? It was opaque beer, which was covered in brown bottles.
Yeah.
Yeah, so they used to call it scud. They used to call those things as scud missiles. But then over time, because of inflation and all these things, the economy deteriorated to an extent that it remained in the ICU for some time. I'm sure the crocodile now has resuscitated it. But what was so visible? It was basically the decline of the real estate. most of even just foreigners, they started buying houses in Zimbabwe because they became extremely cheap. So if imagine you are a real estate company and you have quite a number of housing units in Zimbabwe during that time, what would you do? You have to perform a test of impairment. So that impairment test has to be done because what you are expecting to be generating from those CGUs would fundamentally be reduced because of these external influences, the market value. Secondly, there's what we call capital compression rate. For a place that was so or regarded quite elite, and the value of the properties in that particular area, it was high. Over time, because of that capital compression rate, the value of that particular place starts going down. As it goes down, even the value of the assets also starts going down. Therefore, there is need for you to perform an impairment test. It could be just a change in the technological. So technology may also play a much bigger role in determining the impairment of that particular asset. We have moved over years from the actual QWERTY typewriters to laptops. Now people use laptops. You no longer use those QWERTY typewriters. You should remember them. So they've become obsolete over time because of technology. Secondly, it may actually be.
Is it me or what?
Hello?
Hi, coach.
No, it's here. Someone is trying to call.
I think I. Okay.
Yeah, there's someone who's trying to call.
All right. I had lost you for a sec there.
Sure. So it could also be economic challenges or environment. So there has been a shift in the economic variables in the case of Zimbabwe. And we saw how most companies that were doing fine went under. So obviously, those need to perform impairment tests. And we have given examples of what was happening in Zimbabwe then, before and after. It even became so dangerous for religious people in Zimbabwe, especially Christians, who actually were very prayerful. Because the danger that came in was you needed to specify when you're praying for God to give you money, if such a thing happens, but it does happen with Christians, they always do that. You needed to actually state the currency, because if you don't state the currency to God, God will give you a Zimbabwean dollar. Yes, you'll be a billionaire, but in Zimbabwean dollars, it reached at that stage. So even Christians now became so innovative that they stopped just praying that God make me a billionaire. They needed to state the currency because everyone became a billionaire in that country. If you didn't if you didn't state the currency, then you are in problems. God will give you Zimbabwean dollars.
We were not billionaires, we were trillionaires.
Trillionaires.
Yeah, imagine. So there was need now to modify your prayers because a prayer needs to be very specific. So you needed to start modifying your prayers. So there are all these economic issues. Then there could also be legal environment. There's been a change in the legislation, and that basically affects the value of your asset. And maybe there's need for you to impair it. We have seen with the coming in of NH saving bulbs, those ones that were there, they have become obsolete. And most of it is because they are not environmentally friendly, and there have been pieces of legislation that have been instituted to discourage people from using those types of bulbs. Then we have also internal influences or sources that would actually lead to an organization performing an impairment test. One of them would just be obsolescence or physical damage. So if there is some physical damage to this particular asset that you have, you may be required to perform an impairment test. Secondly, significant changes in the period expected in the way the asset is being used. E.g., the asset becoming idle, plans for early disposal or discontinuing, restructuring the operation where the asset is used. So you have this particular asset, maybe a plant where you build transformers. And over time, there have been legislations that have been passed. And you have no option because you're actually getting squeezed day by day economically. Then you decide that we are actually going to restructure, or we're going to discontinue this particular plant. There will be need for you to perform an impairment test. We know now most of the things that are happening. First, thank to Putney that we no longer have, I think Putin has actually brought in a demise. There's a demise of COVID. COVID has actually is dead because of Putin. Everyone now is concentrating on the Ukraine-Russia war. But then even that, because it's a very big problem economically to most of these countries that cannot stand on their own. So we have now problems of inflation. It's actually going at a level that we cannot manage. The pump price, fuel pump price, which has also affected other goods and services provided in the country. And our politicians now, they are using it as a code to excuse, or as a code that excuses themselves from the blame of a bad economy. So what it means eventually is that some companies may start closing. What do? You have to perform an impairment test. So evidence that the asset's economic performance will be worse than expected. You have analyzed, you have data that looks at the past performance of your asset. And what you are getting from those particular assets that maybe are now fully sweated is less than what you expected. So if your production was at about 80%, you have now gone to 60%, not because of demand, but because of the ailments that this particular asset may have. So what you have to do, you definitely need to perform a test of impairment. If, again, where you have an issue of this particular CGU, the cash generating unit, splitting losses, operating losses, there are so many losses that are coming out. The revenues that you're generating from there is much, much lower than the cost that you're incurring on a daily basis because this asset needs to operate on a daily basis. And the operation of your asset entirely means that you will need to spend. So if the operating costs are actually higher than the revenues that you are getting from that particular asset, then all you need to do is to impair. Then it may also be other input variables that you use to generate your goods, to produce your goods. So if that input, for some reason, is not adequately enough or adequately available, you also have to impair that particular asset. In this case, we look at our power stations. So you look at, for example, Kariba North Bank power station, or Kariba South power station from the Zimbabwean side. You have the turbines, they are okay. If there's enough water, you generate more electricity. But then, because of poor rainfall, has actually affected your reservoir. Your dam cannot keep as much water as it should be because there isn't enough rainfall. So instead of you generating, say, at 750 megawatts, you are actually generating, say, at 200 megawatts. Before that, when you're generating around 750 megawatts, there's some certain or quantum or levels of revenue that you are projecting. And because it has reduced, you need to do the impairment so that you resize the value of those assets according to how much they are able to generate. So any excess fat that is not helping you to generate meaningful revenues or cash flows has to be flushed off in form of an impairment. Those days would actually value a company based on the value of its assets. But what IAS 36 is telling us, let's value these companies based on the ability that the ability of generating revenues or cash flows. So we then now need to get into the future, do a cash flow forecast, say for 5 years and in perpetuity. Then discount those cash flows to today so that we get the value in use. Then that value in use, we then compare it with the carrying amount. So if we find that the carrying amount is higher than the value in use, it clearly shows us that that difference is basically what you would actually state as excess lazy asset. Meaning that you have assets that are not giving you or providing you with reasonable cash flows for you to operate your company efficiently. So what you do with that excess, you need to impair it so that the value of your company at any given time is almost in resonance with the ability to generate meaningful cash flows. So for me, it does make a lot of sense. And year or every audit period, we actually do these financial models to just value our CGUs. And I'm involved in that. It may sadly also mean a loss of key employee. You have these companies where they have bought a very complicated or they buy complicated equipment that are only known by very few of your employees. And unfortunately, those employees, they get dissatisfied. They blackmail you because they want more money. And you become stubborn and say, I'm not going to give you anything. If you want to go, go. They pack their bags, they leave. Then you call one of the employees that have remained. Are you able to operate this? He tries to operate, they cannot operate it properly. Then it starts now affecting the levels at which you are generating your revenues because you cannot produce.
Yeah.
Then there's also the learning curve effect. You understand it better. So at that point, it is also fair that you perform an impairment test. Is it okay? And does it make sense?
Yeah,
it does make sense.
Mm-hmm. We have already explained on this. I think even the last lecture we had, we were comparing the carrying amount and the recoverable amount. And if the carrying amount is higher than the recoverable amount, then we'll have to impair. If it's opposite to that, then you can revalue your assets upwards. So there will be definitely a surplus in your revaluation account. Mm-hmm. Otherwise, you have to impair and should be written down to its recoverable amount. That then affects your bottom line, the other side, in your comprehensive income. We did actually look at what this recoverable amount is the last time we met. That n of the two that is greater between the fair value less cost to sell and the value in use. So n of the two that gives you a higher value, that is the one that you're going to use. So on fair value less cost to sell, if you're saying from this, looking at the market, if we are to sell this particular asset, we'll sell it, for example, at 50 Rand. But that 50 Rand, if I'm to sell this phone, say at 50 Rand, because there are some few things that I need to do before I sell it, what's the cost of selling this particular thing? I need to change the cover and all that, about maybe 5 Rand. So the fair value less cost to sell will be 50 minus 5, which then gives me 45. But then the value in use of this particular phone, if someone checks what is there, the apps and all these other things, finds that the value in use is 65. Then now you are comparing 45 and 65 and you pick the greater of the two, which then ultimately or subsequently, you're actually going to compare with your carrying amount. Makes sense, huh?
Yes.
Yes, it makes sense. It makes sense.
Mm-hmm. Then on the value in use, this is one of the common methods that we use in valuing a company, like I did mention. We look at the future cash flows. So when we are coming up with these models, we do a 5 years future cash flow. The 60th year going upwards there, it's actually perpetuate. So you create that model, you show what is coming in your EBITDAs and all that, your operating cash. You remove any maintenance. Before that, obviously, will be maintenance costs and all these other things. Then CapEx, which you include in there. But also when you're doing that, the standard allows you to compare if you are trying to check the value in use, if the company did the correct thing. You have to check what assumptions did they use, say, on CapEx. or on the maintenance, you'll find in the previous budgets, when you compare the previous budgets and the actuals, you'll find that the budget overstates these numbers. But what eventually comes out is very low. Then you ignore the assumption that they have created. You actually go for those actual costs, because then it shows that they haven't been following their plans. They are not disciplined enough to follow their plans. And most companies, that is what they do. When you look at the budgets, they look so interesting, so colorful. But look at the actuals that are coming out. So you need to do that test as well. There will be issues like the PGR, perpetual growth rate. It should not go beyond maybe your GDP growth. So you need to look at all these things and what the standard says. So after you've gotten, you have done your future cash flows, like I said, you discount them to today. Each time you're trying to make a decision, you are trying to make a now decision, which is now, you always need to know that you are required to discount those cash flows. Because these are cash flows that will be generated in 20, 30 years. You will not be there, but you know that this is the value that we expect to generate in the next year, at the end of the 20th year or 21st or 25th. So it is prudent that that amount you discount today. So you need to bring in your discount factors. So in short, value in use is basically the present value of the future cash flows from the asset. Is it okay? Does it make sense?
Yes.
Yes, it does.
Okay. So the third stage is to record the impairment. That impairment is basically an expense. And all expenses are supposed to be to be charged in the income statement. I wanted to use the term to evacuate them wherever they are to the income statement. So the reduction, the carrying value is taken through profit or loss, unless related to a revalued asset, in which case it's taken to any revaluation surplus. But otherwise, when you're actually looking at the reduction in terms of the impairments, it has to go through profit or loss. If not, then it goes in the source under the revaluation surplus account. So what does this cash generating unit do? What is it? It can actually be a subsidiary company. It can be a specific asset, such as the ones we have in the villages. We call them chigayo, hammer mills. I don't know how they are called the other side.
It's the same.
Okay.
The Bantu languages.
Yeah, these Bantu languages are the same. We are just the same. Yeah, someone came and yeah, we were coming from almost from the same areas. It's either we are running away from Shaka or we are coming from West Africa, somewhere that side. So
yes.
yeah, then others went into Congo, they started coming to Zambia, Malawi, Zimbabwe, and all that. We are just the same. So these languages, these Bantu languages are the same, essentially. Yeah. So on the CGU, while there will be specific assets, these will be specific assets, like I said. There will be issues of goodwill that you have to look at, because you're trying to compute to record this impairment. So this impairment would actually mean that first you need to look at what is the value of this particular asset. What's the goodwill that is there? If there is any remaining asset, again, you use your pro rata assumption. So let's look at this example. It reads, Peter owned 100% of the equity share capital of Mwenda, a wholly owned subsidiary. The assets at the reporting date of Mwenda were as follows. Just get a pen. So the assets at the reporting date of Mwenda were as follows. Goodwill, you had 2,400. All these giving us 17 million kwacha. Then we are told, on the reporting date, a fire within one of Mwenda's buildings led to an impairment review being carried out. So because of the fire, there was need to perform an impairment review. The recoverable amount of the business was determined to be 9.8. So, meaning that we had 17, which one would actually say this was the carrying amount. So we have the 9.8. Then we are told the fire destroyed some plant and equipment with a carrying value of 1.2 million. And there was no option but to scrap it. So meaning that here we'll say the plant and equipment of 1.2 was to be scrapped. The other intangibles consist of a license to operate Mwenda's plant and equipment. Following the scrapping of some of the plant and equipment, a competitor offered to purchase the patent for 1.5. So what it means is that there was also a 0.5 that was gone. There was also a 1.2 that also we had to remove there. Okay. The fire destroyed some, okay, I've read that. The receivable and cash are both stated at their realizable value and do not require impairment. Show how the impairment loss in Mwenda is allocated amongst the assets, not within a group of companies where there are several subsidiaries. The individual CGUs are tested for impairment before the overall value of the business is tested. So here we know that on goodwill, all of it will need to go because this thing actually got banned. So you expect that goodwill that comes in because of reputation or whatever, whenever there's such an impairment, you have to remove this goodwill. So we remove the goodwill. Okay. So how much do we get?
Which one are we calculating? The 17 less that. 1.8, 1.2, 2.4. I'm seeing 3.1.
So this is the impairment that we're going to take. Why are we not impairing receivables and cash? Why shouldn't you? Victor.
Cash, because you're holding it. So there's nothing which have happened. And then I think receivables, the chances of them being cleared, that you'll be holding on to the cash.
Or maybe it's because, remember, receivables and payables, we always disclose them at their carrying value.
Let me give this, no, that example, that example, look. Okay, let me just pick this one. Sorry about that. So the thing that I would ask, the most logical question is, forgive me, look, I'll ask you the most logical question to look very stupid, but ask the most logical question. Let's say this example, let's give this example. Victor owes you 1,800 rands. In the bank, you have 200. Then your company has had all these assets. Then it is burnt to ashes. Your company is burnt to ashes. Would you still impair this?
No, I won't, because it's because I still owe Victor that much, and I still have that.
Yeah, actually, here, if you owe Victor, maybe you can give excuses. But this one, Victor owes you. Sorry, Victor owes you.
Oh, Victor owes me.
Yeah.
Okay, yeah, I was still
obliged to pay.
Yeah.
Yes.
Actually, you even need it more than you.
More. Definitely, yes.
And even the cash that is in the bank, you're not going to say, no, this has been written off because all these things. No, you should get it.
Yes.
So this is why, and it's a classic example, this is why receivables and cash, you don't impair them.
What if they were payables, Coach?
If it's the same thing. It's the same thing. Unless you file for, what do you call it? Is it
insolvency of bankruptcy?
Insolvency. Maybe. But you can't impair it. Okay, so you can tick in on your checklist in terms of the standards. We have done IAS 36. We'll continue strategically or methodically. We'll continue tackling these standards. So we can go to complex groups. When I have to introduce complex groups. Yeah, sure.
All right, it's okay.
So it's a very short, I think about 3 slides on complex groups, but let me just do the storytelling here. For now, let me do this. So on the complex groups, first we looked at just one scenario. a very plausible scenario for that matter, where the parent company or the company A acquires more than 50% shares in company B. Company A, later after the acquisition, company A will be regarded as a parent company. Company B will be regarded as a subsidiary. If company A goes ahead to acquire any company, the shares from 20 to 50, that company will be regarded as an associate, guided by IAS 28. The first one, where the company has bought more than 50% shares, is regarded the parent company. The other one is the subsidiary company, and any interest that you did not acquire, or any shares that you did not acquire, they'll sit with what you would call as the NCI, which is the non-controlling interest. Then if you have a joint arrangement, which requires you to jointly operate, then you'll be guided by IFRS 11 on joint ventures or joint arrangements, as they call them. And the method of accounting is equity accounting. So this is one scenario with its subsets. But the other plausible scenario would be that, and it's possible, nothing stops you, or nothing stops the subsidiary after it has been acquired or before its acquisition, that this company B decided to also acquire company C. So you, as the parent company, you did not directly acquire company C. It's a pencil structure. You acquired the company B, which company B, maybe at the time that you're acquiring it, it had already acquired the company C. That is a vertical structure, which is so possible in the business world. And you, as accountants, you need to be in a better position to know how you account those transactions. So that would be called the vertical structure. Then there's another possibility that, and nothing stops you as a parent company. So where you have the parent company, obviously both shares in the subsidiary company. The subsidiary company as well bought shares in the sub-subsidiary. Then you, as a parent company, also you go indirectly or you go directly and buy shares. It doesn't matter how many shares you buy. Even if you are the minority in that particular area, you buy, say, 20% of the shares. The fact that the subsidiary, which is under your wings, has a subsidiary, then you still have control and consolidate the whole thing. This is what we are looking at. So today is just a theory part. Tomorrow, possibly tomorrow, I know we have a holiday on Thursday, Kenneth calendar holiday. I wish you had that holiday as well. Then we would actually meet on Thursday. We'll look at the questions, but for now, it's just a theory. Is it okay?
Yeah, that's okay. And
that's fine, Coach.
Okay, so now I can share. I'm done with this storytelling. Are you able to see the slides, the PowerPoint?
Yes, yes,
Okay.
we can see.
Yes, we can.
So this is what I have already explained. A complex group structure exists whereby the subsidiary within a basic group structure has an investment in another entity that gives it control of that entity, which effectively becomes a sub-subsidiary. There are two types. You have the vertical complex group structure and the D-shaped complex group structure, which I've already explained. So what it does is that the consolidation of a complex group structure will follow the same principles. Like I said, those 5 stages, it will follow the same principles. There'll be some few tweaks here and there, but it will basically follow the same principles. So the only tweaks will be only working 3 and working 4. That's it. On goodwill and on NCI. So let's check. So if you see this part, we have the parent company bought 80% of the shares in the subsidiary company. The subsidiary company subsequently bought shares in the, in the sub-subsidiary, 60%. So it means that the fact that the parent company controls the child, meaning that indirectly they control the grandchild. So as we go to here, from S to SS, the parent company doesn't have 60% of the interest. The parent company has 80, the 60, which I don't know, what's the thing? 8 times 6.
48.
48. So has 48 control or effective control. So I think P has control over S as it owns it greater than 50%. The NCI there to be 20. Here, the NCI, the relationship between P and the SS, the NCI is actually going to be 52%. Is it okay? Is it okay?
Yes, it's okay. It's okay.
So this is what would happen on a vertical complex group. Do this. This side, it's actually going to be normal. The subsidiary. So this is where you have your relationship, the parent company, relationship with the subsidiary company. This is what you know for now. This side, you as a parent company are coming in there indirectly. So the fair value consideration here is actually going to be times 60%, times 80%, sorry, times 80%, this control that you have here. Then the NCI at acquisition, that would be normal. Here, obviously, this is where now you're going to have the NCI at acquisition, you'll be given the question. Net assets at acquisition, you'll be given the question, and you have your goodwill, you have this goodwill there, and you add the two. I know tomorrow I'll be demonstrating, we'll have two also examples. On the non-controlling interest, this is where it is interesting. There will be some few adjustments that have to be made. Because there's a component of double entry that you need to flush out from your normal NCI computations, your relationship with P and S this side. here, this is where you need to get, if the cost of S in the subsidiary. Remember how your balance sheet is. You will show under P non-current assets. You have investment in the subsidiary, which you will show as P here, that this is what you have invested. Then you have the subsidiary this side and the SS. Then you have investment in SS, which you will show there. So this number that you are going to show here, that is the number that you will need to multiply the NCI percentage times the cost of subsidiaries investment in here, so that you adjust your non-controlling interest. That is the only trick that is there. You are just flashing out the double entry component. Then this side, it is normal. You have the NCI at acquisition, which obviously you get from up there, times the NCI at post-acquisition. Whatever you get, this total plus this total is what it will find itself in the financials, in the balance sheet. So these are the only tricks that I'll be demonstrating. Tomorrow, I know we'll look at the full question, but what I would do is that I'll send that question so that you look at other components first tomorrow. You look at other components, then when we come here, you let me put on an overall or a worksuit so that we work together, then do the balancing. Hello, in theory, is it okay?
Yeah, for me it's okay.
That's in
For
theory.
me,
I know.
I will need figures because
Yes, yes. So when you start looking at
For me
figures,
to get it.
the concept will even be more clearer.
Yeah, yeah.
Then we have the D-shaped complex group structure, which I'd already explained. This relationship here, obviously you do your computations like this. Then this other relationship that goes like this is very easy because there you actually go direct. When you're looking at your goodwill and all those things, it just basically goes direct, which obviously we'll look at it when we are done. Tomorrow when you start looking at computations. For now, this is how it's going to work on D-shaped. So on fair value of consideration, you have the direct component, which you obviously you have to multiply by your control in the subsidiary. Then you have the indirect, which you are going to plug in there as is because you have your 100% or whatever amount that you have put in there. Then you have your NCI and do the usual, which is okay. And that's it for today. So we'll be meeting tomorrow, but before that, as usual, you will need to check out.
Yeah, interesting.
For me, yeah, I think.
Impairment. Okay, you can go ahead.
Yeah, it's interesting. Yeah, in theory, like Victor has alluded to, I think when we get numbers and do one or two, we'll be able to let it sink in more. But for me now, in theory, with coaches storytelling, I think I won't go wrong. It will always come back to me in my subconscious mind, and I'll be able to apply. We'll see tomorrow when we start doing some examples.
Then on IAS statistics,
I think IAS statistics were a good base, and we had already started. We had already highlighted or taken us through the impairment process. So it's actually it just cemented what you had already given us as a base.
Sure. Look.
Yeah, I think that's it. The IAS 36, because we did it our last lecture. I think we did some scenarios with that. So that one is just a repetition and us grasping the concepts more and more. Yeah, complex group structures. Yeah, a lot has to be mastered there. Hoping when we get when we do together the questions, we'll get the tricks.
Sure.
Yeah.
Okay, so for now, thank you so much. See you tomorrow and bye-bye.
And then for tomorrow, Wednesday, my Wednesday is tied
Yeah,
up.
let's have it on Thursday. Let's have it. Because
Thursday and
tomorrow,
Friday.
obviously,
That's okay.
yeah, tomorrow, obviously, it's on Monday we have a holiday. On Thursday we have a holiday, KK's day, and we have to honor our first president. So maybe tomorrow I may also just be in hiatus. so tomorrow maybe we can reserve it for such.
That's okay. See you on Thursday then.
Yeah, Thursday's okay. Yeah.
All right.
Thursday end time. I know you guys will be busy, but if it's during the day, then you can just let me know, since it will not be doing anything substantial.
All right, that's okay. We'll communicate.
Okay. Then
Thanks,
did
Coach.
you have time to talk to Luke? Did you have time to talk to Phil?
I didn't. I thought I had time, but like